Hi everybody! This video is about anticipating signals with Japanese candlestick reversal patterns in a lower time frame. We're actually quite lucky. The market offers me an opportunity to show you an example with the trade that I opened this morning. So before this, I would like to tell you that as you have purchased this course, you might want to have access to an after-sales service that works like a regular ongoing training. You can have this for free if you join my forum, where I announce all my trades in real time. Here you have the watch group. Then we chose the long-term watch group. Then you go on the last page to see the active signals. And here you can see at 9 a.m. I mentioned the opening of my Euro Australian dollar position. So here I give all the details and I explain that I opened a position early this morning. So the trade is actually unfolding well, and we're going to try to understand what I've done, how and why I've done so, and basically how I anticipated a signal in a lower time frame. So this is the Euro Australian dollar weekly Forex chart. I'm going to remove the rectangle, but if you're well aware of Ichimoku, when the cloud is twisting and orients itself horizontally, well before we had more than one contact point on the lower and the upper limit, there's a significant probability that a range phase has started. This is pure Ichimoku analysis. Once we've noticed this, we also know, as we've seen in the previous videos, that if on the top of a range we have a reversal candlestick, it's possible after its closing to open a position with a stop above the tip of the shadow and with the target at the equilibrium zone of the range or at the lower limit of the range. But in order to do so, we must wait for the closing of the candlestick. And this morning, Friday, October 13th, when I announced my trade, it was 9 a.m. and the weekly candlestick wasn't closed yet. It closes tonight around 10 p.m. or 11 p.m. depending on the broker. So I didn't wait for the closing of the candlestick. Why didn't I wait? Because I'm always worried about missing the opportunity window that would let me achieve a good ratio. The holy ratio that allows me to open a position. Look at this weekly reversal candlestick here. It's an engulfing pattern. Let's pretend this candlestick closes today. So at this moment, I entered the trade at the top of the range at 1.5110, but if I wait for the closing tonight, nobody can tell what the price level of this candlestick will be at the closing time. Let's guess that it will close at 1.4874. You can see that we have a 200-point difference here, so this wouldn't be a very enticing prospect anymore. It's very likely that my golden ratio wouldn't be achievable anymore. Okay, the example is a bit exaggerated because it's a weekly candlestick and it took this candlestick a whole week to go down that far. But I don't know if the candlestick is going to close at 1.5110. Here, I already won 70 pips since I opened the position this morning. Maybe it's going to close lower, maybe not. Maybe it's going to reverse and retrace all 70 pips. But anyway, as I didn't want to wait for the closing of this candlestick, and in order to achieve an excellent ratio, I've anticipated in a lower time frame, and I'm going to show you how. Before this, I must tell you that I don't usually mention how much money I trade, how much I lose, or how much I win. I do it here for transparency purposes. We're on my live account. This stop here at 101 euros is supposed to reflect 1% of my capital, which suggests that my capital is 10,800 euros. But it doesn't necessarily reflect the size of my capital because I could also risk much less than 1%, especially on Fridays as I don't like to stay in a position over a weekend. So on weekends, I generally do it with a weak leverage ratio that doesn't necessarily reflect the size of my capital. What really matters isn't the size of my capital or the size of my lots. What matters is that I have a stop loss set at 108 euros. If I lose the trade, I lose 108 euros. And my target here, even before the equilibrium zone of the range in case prices at least retrace on the SSB line here, would give me a profit of 276 euros. So this is almost a 1-to-3 ratio. That means if I win this trade, I'll be able to lose 2 trades in a row and still be profitable. I hope you do understand the importance of the ratio. So the reason why you anticipate your entry position with reversal patterns in lower time frames is not really to make more money, but to achieve better ratios, which is a totally different idea. So now I'm going to use this red arrow to point to my entry level over this nascent shooting star. I'm not waiting for the closing tonight to get a confirmation of the shooting star. I entered this morning based on the information delivered by the daily chart. What does the daily chart tell us? Here you could ask me, why didn't you trace a daily range at the closing of the daily candlesticks here? Well, because I choose the weekly time frame as my main time frame, and what sticks out here from the upper limit of the range is nothing else than the upper shadow that you can observe in the weekly chart. So we go back to the weekly chart. This wick that you see here matches the candlesticks that overflow the upper limit in the daily chart. So this wick informs me that I have my famous upthrust. See the previous chapters and videos for this. Last night at the closing on Thursday, the 12th of October, look here. We have an engulfing pattern. This is the Forex market, so it's normal that the opening level of the candlestick that's going to engulf the previous candlestick is at the same level as the closing of the previous one. Remember, this is a typical Forex pattern. So this tells me that I actually have a reversal pattern on the daily chart. It allows me to enter on the weekly chart before the closing of the weekly candlestick tonight. This is to achieve a better ratio. But there are always two sides to a coin. So here you must apply the golden rule. The information delivered by the higher time frame always prevails over the information delivered by the lower time frame. What does this mean, practically speaking? It means that if tonight, after the weekly candlestick closes, the signal that I interpreted as a probable sell signal, because of the weekly candlestick here, will very likely form a shooting star. And for the moment, I actually have an upper wick that's twice the size of the candlestick. So if anything happens before tonight, like an economic statistic or whatever, then all this could reverse. Let's just imagine that during the day, this downward trend is totally reversed, and that the closed candlestick looks like that. I'm going to make it green. On the daily, it'll look really big, but it doesn't matter. The important thing to understand is the idea I want to convey. So now at 3:49 p.m., prices are at 1.5136, and until tonight, everything is possible. It happened before already. Look at this weekly candlestick, for example, or even this one here. Prices went down, 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 and they finally close at the top. So here also, we can have prices plummeting, and then a brutal reversal from the buyer side could push the candlestick upward again until it ends up here. So what I saw as a future sell signal, a nascent shooting star with an upthrust under the resistance level, finally becomes a potential buy signal. Now let's have a look at all of this on the daily chart. Here you can see my stop above the upper wick. We always set the stops above the higher wicks, overflowing the limits of the range. So if this candlestick closes at 1.5234, knowing that my stop loss is at 1.5300, I'd exit tonight. I'd have time to see this coming if I briefly take a look around 8 or 9 p.m. And if prices have moved back above my entry level and close to the upper limit of the range, this candlestick will very likely turn into a buy signal. Because when a range gets broken like here, it's always a buy signal, even though you can't always expect a throwback or a pullback in the case of a bearish trend. So I have no reason whatsoever to wait until prices hit my stop loss. Because if this becomes a buy signal, it's very likely that my stop loss gets hit. So instead of losing at 1.53, I exit at 1.5230 and I save 70 pips. This will substantially minimize my loss. So if the signal that I saw on the lower daily time frame gets invalidated at the closing of the weekly candlestick, I must exit the position on the spot, without even waiting for my stop loss to get hit. This is the risk that you will be facing if you anticipate in lower time frames. On one hand, we can achieve much better ratios by anticipating in lower time frames. On the other hand, the drawback is that this trade signal can be invalidated in the higher time frame, and in this case, we must exit on the spot. That's it. No need for further examples. If you combine this video with the written part in the course, it should be crystal clear. Talk to you soon in the next video.